How might you go about selecting the right bond fund for your portfolio? Well, here to talk with me about that is Massi De Santis from Desmo Wealth Advisors. Massi, welcome.
Hi, Bob. Thank you.
So you recently wrote an article about this very topic for Retirement Daily. We're eager to have you walk us through it.
Yes, my pleasure. It's really a topic that I think it's very important in bond portfolio. How do you build the right bond portfolio? There's a lot of focus out there from investors on growth and equities, and sometimes they look at bonds the same way. They focus on growth and yield, and so now they don't know what to do because we are in low interest rate environment. And I think the first step is to really remind people what bonds are for. What is the role of bonds in a portfolio? And it's not really growth. It's really to help you manage the risks that are important to you for your goals. Once you have that view of the goal, then the interest rate environment becomes secondary, as we will see. And so I think that's something to focus on. And the bonds are great to do that, to help you manage your risks, because there's so many different bonds, so many different types, that you can really tailor a bond portfolio to your needs. And that's the key to understand with bonds. So you'll have bonds with different payment schedules, different maturities, inflation protected or not. You have corporate bonds, you have international bonds, government bonds. You have so many different type of bonds. That the idea is build a portfolio of bonds that most closely match your goals. And so I show you in the article how to do that, and we'll talk about that. There are a number of levers that you can use to do that. Right. And so once you realize that, really the benefit of that bond portfolio is to make your overall portfolio more efficient. I use the car analogy in the article, and it's like, if you have great brakes in a race car, it's not going to help the race car go faster, but it's going to help you go faster around the track, which is your goal, right? So if you're not a race type, it's going to help you. Good brakes are going to help you arrive safely at your destination, wherever it is you want to go. And so what that means is that if you're more efficient and you have a good brake system, you have good bonds, what that means you can take more risk with the growth assets. And so that's important to realize. And then once you realize that, then the low interest rate environment becomes a secondary point. This approach works all the time. In fact, it should work even more in a low interest rate environment. It's like having a good MPG in your car. It's more helpful when gas prices are higher. And this is the same exact situation where we are. We want to be as efficient as possible in building the right bond portfolio so that you can take more risk with your equities and have a more efficient portfolio. And so what are those four levers that you can pull? Well, number one, it's called duration. It's basically really related to the maturity of the bonds. So bonds, maybe 1 year bond, 2 year bonds, 5 year bonds. That's the maturity of the bond. Bond investors call that duration. And so if you look at any bond fund, it will report the duration of the average duration of that bond. And so if you have a long-term goal, you can go longer in the duration. And if you have a short-term goal, you go shorter. So typically you want to match the duration of your goal. Like, if I got a retirement goal in 10 years, or I want to buy a new home in 5 years, that's the kind of the duration of your goal. You want to match it to the bonds that you have. That's number one lever. Number two lever is default risk. What does that mean? Well, when you're basically buying a bond, you're lending to the issuer of that bond. And so different borrowers have different ability to repay, make the payments. And so if higher risk of repayment should pay you higher yield. And so that's called the default risk. It's another lever that you can use for different goals. Not all the goals may warrant a usage of higher risk bonds, but some might too. And so that's lever number two. Lever number three is inflation protection. In some cases, the purchasing power is important, preserving that through inflation protections. There are some bonds that give you payments that are linked to inflation. So sometimes they're called inflation-linked securities or treasury inflation-protected bonds. Those type of bonds help you preserve purchasing power. So that's lever number three. And finally, you also have a global choice, a global opportunity set. So you can buy bonds, US bonds, but you can also diversify across different countries. And that helps you, for example, if you have low interest rates in one country, you can buy more bonds in other countries that may have higher rates. So you diversify. And so how do you use those levers? Well, it depends on your goals. right? And I really identified three key goals that I think can cover the spectrum of different goals investors may have. Number one is the growth goal, right? A lot of people come and they want to grow their portfolio over 20 years or 15 years or what have you. Typically, long-term goals are 10 years or more. And those are typically heavy in equities. So you have a lot of stocks in those portfolios. So the role of bonds there, it kind of smooth out the ride. And so even like 10 or 20% in bonds in a portfolio like that will bring down the volatility a lot. And so what's the best way to do that? Because the goal is long-term, you have some flexibility. Number one, you can use a longer duration bonds. Like I said, maybe intermediate. It turns out when you look at different interest rates, intermediate bonds have higher yields, higher returns over time than short-term bonds. So you can go a little bit longer for long-term goals. Also, you want to have corporate bonds in there, not just government. Government is the safest, but you can add corporate bonds there to have an extra yield. None of this has a huge impact on the volatility. So it still helps you reduce the volatility, but it offers relatively higher growth than short-term government bonds or money market funds. So try to go longer in duration, more corporate bonds. You don't need inflation protection here. So, typically just corporate bonds, an aggregate bond fund would work great, especially a global, in this case, you want to diversify across different. So you have a core aggregate bond fund would do well in this type of portfolio. Now, at the other end of the spectrum, you have a shorter term, a wealth goal. For example, a down payment on a house 3 years from now. That's one goal. You've got kids going to college in 5 years. Those are big purchases that you have to prepare for. At the end of the horizon, you have a liquidation. So you sell your portfolio and then basically you achieve your goal. And so those obviously are shorter in term. Therefore, you go a little bit shorter in the duration of the bonds. And I give some example of indices that you may want to think about in the article. So shorter duration. Also, you don't want a lot of corporate bonds, especially if they're more riskier. So if you have corporate bonds, they should be high investment grade bonds. And over as you get closer and closer, maybe you put more and more into government bonds that are shorter terms as well to reach the goals. Again, here inflation protection is not a big problem because it's such a short-term goal. So, but if you're concerned with inflation, then you could add some inflation protection as well. So that's the short-term goal. And then finally, you have an income goal. That's the retirement income. Maybe our readers, they're more interested in that one. And I think the number one consideration that I always remind people in retirement, even if you've already started your retirement, your goal is long-term. Because, retire today, you have 25, 30-year horizon. That's a long goal. So for most people that I talk to when they're, doing retirement planning, they have a 20 to 30-year horizon. That means the average maturity of those payments that you're going to get over time is going to be about 10 to 15 years. So long-term bonds, so look for the name long-term in the bond portfolio, that will help you. So that's the number one consideration. You don't have a lot of growth assets. I think some growth assets are useful to help you preserve the purchasing power of that portfolio over time, but you don't, the focus is really on the fixed income. So longer term credit. So corporate bonds are useful there too. You have to know a little bit the corporate bonds to understand them, because sometimes, like last year, for example, in March, when the stock market started going down, corporate bonds also lost some value. But if your horizon is long, those short-term movements shouldn't worry you, and so you can get a little bit higher yield on those longer-term and corporate bonds that help you generate more income. And you don't need a lot of boost. Like, for example, even 0.5% or a 1% increase in yield can make a big difference over a 20-year horizon in terms of the income level that you can sustain. So those are really the three goals. And then you say, well, what about other goals? Well, if you think about it, and we explained that in the article, other goals are just a combination of these three. So, for example, even if you're thinking about retirement income and it's 10 years down the road or longer, then your portfolio may be focused on growth, and then you transition towards that income portfolio we just talked about. It's the same with wealth goals. And so we have actually, if you remember, we wrote an article for helping people So there's a link in this article. You can go back and read how do you build that portfolio? How do you build that? It's called a glide path. How do you transition from growth to then generation of income or other type of goals? And so we've done that. And so then basically, how do you put it all together? I think always start from your goals. And if you have multiple goals, you build different portfolios for those goals. And then obviously you add it all up, but at least you have the right investments for you. So it's a bottom-up approach, I call it. You start from each goal, decide what's useful for that goal, and then you put it all together. Typically, 2-3 goals is what most people really focus on when they build a portfolio. And so, going back to the interest rate question, now once you understand the role of bonds and how to build a portfolio, then this approach always works. Lower rates, high rates. The key is to have the right bond portfolio for your goals, and don't focus so much on yield. Focus on having the right bonds, because then the yield part comes from your growth assets. That's where you want the growth, and the ability to generate income also comes from that too.